Hey everyone, if you're looking to get started investing in real estate and you want to learn more about how investors approach making money in real estate, stick around. I'm going to go through the two approaches that they use. If you're new to my videos, welcome. My name is John Cummings. I'm with Better Homes and Gardens Casadon Realty. And my hope with this channel is that I can provide you some value with any real estate need you have, whether it's financial and investment property, market specific information, or anything else. I hope that I can reach and help you in some way to provide you some value. Today's topic, we're going to talk about investing in real estate, and it's a very broad topic, but specifically we're going to talk about investing for cash flow versus investing for appreciation. And before I move on with that, I just want to say that both approaches are very good ways to make money and to build wealth, and they're often used in conjunction with one another. But it just depends on what you want to focus your time on, and what you believe you're good at, and how you want to invest. It just varies situation by situation as well, depending on the property. But let's get into it with investing for cash flow. So when you're investing for cash flow, basically what you're trying to do is to have your income or your rental income exceed your expenses. So you can do this by having a short-term rental or a long-term rental. It doesn't really matter which, but your intentions are basically to hold on to that property and just have the cash flow every month. So basically you get your income minus your expenses, and that gives you your net operating income, or your NOI. So what's important to note about your NOI is that this does not include your debt service for the property. So if you intend on taking a mortgage out for a property, just know that when you're looking at some of the investment listings and they say what the NOI is every year or every month, just know that does not include the debt service on that. So it's very important, because you may think that you're going to be making so much money a month, and then you forget that you're putting a mortgage on that, and that's going to take out a monthly cut of your income. So you may be in the negative right from the start if you're not paying attention to that. But why is cash flow important? Cash flow is important because it allows you to hold on to a property for an extended period of time, and that's your main goal when you're investing for cash flow. Is you want the cash flow so that you don't have to feed this property. You want it to produce a monthly income, and you want to hold on to that property for an extended period of time. And by doing this, you could build your equity through the property without actually having to put money into it. And basically, because your renter or your short-term renters are paying for the equity in this property, so you're building equity, but you're not actually putting any money into it. Now, you do have to manage the property, of course. If you're having short-term rentals, that's a lot more work than if you have a long-term rental in there. But they're both successful ways to get cash flow and to hold on to these properties. So now when we go to investing for appreciation, it's different in that it's a very short-term approach to real estate investing. And when you're investing for appreciation, appreciation is basically the value of your property has grown for some reason or another. It could be the market has just increased in value for the property, and like we've seen in the past couple of years, property values have gone up significantly, much more than they have in the past. And nobody really had to do anything. The market just determined that your property value went up because of supply and demand. Or you could put in sweat equity, or what people commonly refer to as flipping. Flipping a house, you buy a distressed property, and then you fix it up, and you've increased the value. So, and then you go ahead and you sell it. You sell the property, and then you have the profits that you've made. So that's definitely a shorter term strategy when compared to a cash flow long term hold. But what is better? It's definitely up for debate. I know there's a lot of flippers out there that make a lot of money, but there's also a lot of investors out there investing for cash flow that make a lot of money as well. So just going through some of the pros and cons of each. Investing for cash flow is what I would consider investing for monthly semi-passive income. So it's not totally passive. You still have to get a tenant in there. You still have to manage vacancies or any sort of issues that arise with the property. Even if you acquire a property manager, you still have to manage the manager. And you're ultimately responsible for that property. So it's not totally passive, but if you do a good job managing the property and keeping it up to date, it could be a great semi-passive income that you have. Your income and expenses are usually well known ahead of time. So your income, if there's a renter in there already, or even if there's not, you could look at the rental incomes in the area, so you could get a good idea of what rents will be for what you're looking to purchase, as well as the expenses. So you get insurance quotes ahead of time. You could get the electrical, the water, sewer. Contact the municipalities, and you could find out most of the expenses, if not all of the expenses, before you put an offer in even. So you should have a really good idea of what your income and your expenses are going to be, and then you'll also be able to get your mortgage, your mortgage rates known ahead of time. So you'll basically know all of your expenses and all of your income, pretty closely. So before you even put in an offer, you'll likely know what your NOI is going to be and if it's worth doing or not. In addition, you're going to get tax benefits for buying a property and holding it as a long-term rental, and that's through depreciation. So basically, if you have let's say your property is kicking off $200 a month in rental income after all of your expenses, at the end of the year, you may be able to have all that taken off of your taxes through depreciation. So basically, that depreciation offsets all of your income, and you've basically gotten that money tax-free. So those are some of the pros with investing for cash flow. Some of the cons are, like I said, you have to manage this property, and it's a long-term strategy. So you're going to be managing this property for extended periods of time. You could be having this property for 10, 15, 20 years, and you'll have to manage it. You'll have to manage all the vacancies. You'll have to manage all the property repairs, and that's you'll have to do that. So it's not a quick strategy. When on the flip side, going for appreciation, it's much quicker. You'll get some of the pros are you're going to get your quick returns. So if you're going to flip a house, usually 6 months to a year is typically how you'd like to do a flip, and the quicker you could do it, the better, because the market changes. This year is a great example. In 2020, or this past year in 2022, if you started a flip in February and you weren't able to sell it until November or December of 2022, it was a much different market, and some of the the equity that you gained through fixing the property, if not all of it, could have evaporated just because the prices of homes started to come down because of the increase in interest rates. So it needs to be a quick strategy because the market can shift. But again, that is a pro. It's a quick strategy. You get your money and your returns a lot quicker. Another pro is you can get a lot more motivated seller leads through this approach, because if you're looking for distressed properties, there's a great chance that the owner of that property doesn't want to deal with fixing it up. So you can get much better deals than if you're buying a property that only needs a little bit of work or is fully turnkey. So the initial profits are quicker. You get motivated sellers and find potentially much better deals. What I don't like, and the cons to investing for appreciation is, and this is one that I really think is true, and I it's not for me really, is you're only as good as your next deal. And what I mean by that is if you're flipping a home, once you flip it, you need to go out and find another home right away and flip it. Otherwise, you have nothing else coming in. So you have to continuously be filling your pipeline as you're working on a flip that you're already doing. So it's a short-term approach, but to flip, but it's in order to be successful long-term, you have to continuously be filling that pipeline. And in addition, it requires a lot of management, in that flip period. So, just managing the contractors alone, and buying and selling the property, that's a lot of work, especially within, 6 months to a year period. You're going to be, pretty busy, doing that flip, especially if you're not really experienced in contracting, or you don't know a lot about, repairs. It's definitely time consuming. And then, another con to this is you're going to pay taxes when you sell that property, via capital gains tax. So basically, you put in all this work to fix up a property, and you grow the value, you go to sell it, and some of your profits get evaporated just through taxes. So, some may say it's not really worth it, but like I said, a lot of flippers do make good money doing this, and it's definitely a strategy that could be done. Now, both of these strategies, like I said, they're great approaches to building wealth in real estate. But I think the general consensus, between those in real estate is that you would prefer to hold on to as many properties as you possibly can, and reap the benefits of the cash flow. And the reason being is that you're getting cash flow every month through semi-passive income. You're going to get that appreciation as well. It's just going to take longer. So you're still getting appreciation in that property. It's just going to take an extended period of time. It might take 10 years until you're able to either cash out, refinance, or sell the property. But as long as you're able to keep a renter in there, you don't really have to worry about what the market's doing. So that's really nice as well. Is you're not market dependent really. You could sit and wait on that property until the opportune time to either sell or cash out, refinance. And if you cash out, refinance, just remember you're getting that money, and it will be tax-free money that you can get because it is a loan. But if you have a renter in there paying for that cash out, refinance, you could basically rinse and repeat and do that over and over and over again and keep getting that money out tax-free. And that's what a lot of these investors do. So that's why, investors or those in real estate typically say that, to build generational wealth, you want to hold on to as many properties as you can. And in addition, you're going to get tax breaks for keeping these properties and having rentals. So that monthly cash flow that you're making could essentially be tax-free as well. So, it's really successful approach. And, flippers, they also make, that's a really great avenue to go down as well. And I know a lot of people that, they'll flip and then they'll put that money into a buy and hold. So again, there's a lot of different ways you could do it. But those are, some of the pros and cons about investing in appreciation versus cash flow. If you ever have questions or comments or like discuss further, put them in the comments section below, or subscribe to my content, and you'll see some videos that I put out further. So thanks everyone. Have a great day.